It's done.
Okay. Okay, guys. So today, I'm going to talk about the market psychology. I know this is one of the most important parts when it comes to trading. As some say that trading is 10% technicals and 90% psychology. Some they say it's 80% psychology, 20% technicals. It doesn't matter. But what matters is psychology is one of the most important thing, and that it's key to be a successful trader. So the following notes that I'm going to present to you, they are based on my own understanding of the markets. They are my own notes, right? So the first thing we are going to talk about is what is market psychology. So this refers to one's mental behavior when interacting with the information generated by the markets. So these are the following behaviors that I have listed, although there are many, but these are some of the major behaviors that we have, or at least we are what? We are trading. So we have traders who are affected by fear. Some they are affected by greed. Some they are affected by what? Hesitation. Some they are affected by egotism, right? So we will start on looking on what? On fear. How do fear affect traders? Fear affects traders in many different ways, right? So you can see that I have wrote FOMO, which is formal, one of the other fears that we have as traders. Fear of what? Of missing out. You will see that we have traders that when they are trading or when they want to enter a trade, before they enter a trade, they always have that fear of missing a trade, whereby it will result in them entering early in the trade without having confirmation. So this kind of fear is caused by not having an understanding of the methodology that you use, or of the method that you use when it comes to what? To trading. So I'm not going to talk much, or I'm not going to go in depth about these behaviors, but the following behavior is the greed. We have traders who are greedy. They want more from the markets. They want to make more money from the markets, which is disastrous to many of us, because we end up risking more. We end up taking a lot of trades of poor quality, whereas trading is not about the quantity of trades that you take, but it's about the quality of trades that you take. Okay, so we have fear, we have greed, we have some traders who are hesitant. They don't enter the market when they are supposed to enter the market. Why? Because they are hesitant. They are waiting for the perfect moment, whereas the markets are imperfect. There is no such thing as called perfect moment, right? And we have other guys who are infected by ego. These guys, when they win, let's say they win 4 or 5 trades consecutively, these guys, they start feeling as if they know everything, as if they control the markets, as if they are the market makers. And what happens to these guys? They forget what made them to win those trades before. Meaning, they now do not respect their risk. They now do not follow their rules. Why? Because now they feel like they are the gods of the markets. They understand the markets. So every trade that they are going to take, it must result into a profitable trade, which is dangerous. And the next thing that happens, they are humbled by the what? By the markets. Okay, so those are the sum of the behaviors that we have when we are interacting with the what? With the markets, right? So moving forward, without wasting much of your time, I have this subtopic that I have called installing the probabilities mindset, right? So before we start placing trades, we need to understand the nature of our business. What do I mean? Uh, as traders, as we trade, uh, we have to understand that the markets, it's an environment of what? Of probabilities. There is nothing that is certain in the markets. Nothing is certain in the markets, and nothing is obvious in the markets. That has to sink in your head, right? We have heard people saying trading is a game of probabilities, which is true. But the question is, are you in acceptance with this principle, or you are just giving lip service to the idea? So as we traders, as we trade, right, we have had this saying that, okay, trading is a game of probabilities. But you do you really accept that you are dealing with probabilities, or you are that trader that when you take a trade or when you place a position, it has to result into a profitable trade? So once you think in that manner, whereby when you take a trade it has to result in profit, you have lost it. Why? Because if that trade doesn't result in a profitable trade, it's going to hurt you. It's going to hurt you big time. It's going to affect you mentally. It's going to affect your emotions. Why? Because your expectations, they were not met, right? So we need to understand that the market is an environment of uncertainty. Nothing is granted there. Okay. So these principles, they have to sink in your head that you are dealing with what? With uncertainty in the markets. There is no guarantee that your trade is going to be a winner. There is no guarantee that your trade is going to be what? A loser. You can take a trade with all the confluence, right? A perfect setup. The best confluences that you know, and still it will result in a what? In a loss. And that doesn't mean you are not a good trader, but that's the nature of the business. So what I'm trying to point out here is you can take a trade that has all the confluence, everything that you know of your method, that is there, it's on the chart. And that trade might result in a loss, right? And this doesn't mean that you did something wrong. No, it's the nature of the business. These are probabilities. Anything can happen. So it has to sink in your head, guys, when you are trading, that anything can happen, right? A lot of traders, we struggle to accept that we are dealing with probabilities. We struggle, guys, we struggle. But we have to be in acceptance of that we are dealing with what? With probability. Every trade we take, we expect it to be profitable. When our expectations doesn't correspond with the outcome, it damages emotionally and financially. We are so reckless. We take trades as if we control the markets. You have to understand that you will never be in the control of the outcome. The only thing you can control is your risk. So we can only control our risk. We cannot control what the market is going to do next. It's impossible. It's impossible. It's impossible. You have to understand that part. You have to understand that part. Sorry. Okay. So now we move to the next subtopic: detachment from the outcome. Right. Do not focus on the results of one trade. Focus on a collective of trades. Okay, so we have traders whereby they take a trade and it results in a loss, and they what they do, these guys, is they judge themselves based on one trade. So they are affected by one trade. Their emotions are affected by one trade. But there is a saying that says one trade shouldn't break you as a trader. So we have these guys who are affected by just one trade. They are affected by just one loss. And that one losing trade, it will affect their decision making on the next trade, which is dangerous. So one trade is just one trade, right? So one trade is simply one trade. Its outcome shouldn't affect your psychology negatively, right? It shouldn't affect your psychology negatively. Okay, so the next point under detachment. So do not marry a trade. What do I mean? As I said, that you can take a trade with all confluences and it results in a loss. So we have these kind of people or these kind of traders whereby when they take a trade, they marry a trade, they are attached to that trade in a way that they do not pay attention to the changes that are currently happening in the markets. You may take a buy setup, right? There are confluences of a buy setup, but then changes or the markets start communicating to us that a reversal is about to take place. People will ignore that message of reversal because they have married the trend, they have married the trade. They are in belief that this thing has to buy. So they don't see the other side, that they're dealing with what? With probabilities. And this is very dangerous because you are only thinking one way. You are not thinking in a two-way manner. So you need to think in a two-way manner that, okay, we are buying, right? But these are probabilities. Sellers can come in the markets and the trend can change. So they do not that message that the trend is about to change, right? So they keep on holding to those buy positions, marrying the what? That's marrying the trade. The next point, do not marry a trend. So you shouldn't be married to a trend. What do I mean? Like we are going up, 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 right? We are taking our buying setups, and now we are starting to the trend is starting to develop into a reversal. We are seeing reversal patterns, the head and shoulders, those things they are forming, right? And you, in your mind, you are still looking for buying opportunities, but you're already seeing that the trend is reversing. So you shouldn't marry the trend. You shouldn't marry the trend. Okay, so the other part is do not marry your trend lines, right? This one I will show you on the charts. I will show you on the charts what do I mean by do not marry your trend lines, right? Let me explain this point a bit. You can see in the brackets I said methodologies, right? So we have different methodologies that we use. There is ICT, there is smart money concept, there is price action, right? So this is what people do in trading. When they see that there is what people call the signature trades, whereby it's something that it's a trade whereby all your confluences are met, right? So people they think that they will not lose from that kind of a setup. Why? Because it's a signature trade and it always plays out, right? But if you go and backtest your markets, this thing that you're calling a signature move, if you backtest it, you will find it that it's not going to be 100% thing, or it's not going to retain the same results 100%. You will find out it will retain the results maybe 90%, right? Meaning we have that 10% that this thing is not going to happen. So we ignore that 10% and we marry our methodologies, like the method that we are using is invincible. We cannot result in losses. So that's another point which is crucial and it's very dangerous doing that. Okay, but I will show you on the charts now, right? Let's go to the next sub topic, the systemized approach, treating trading like a business, right? Okay, so if you say you are a trader, you want to be a trader, guys, we have to be serious about trading, because trading is not easy, guys. It's not easy. When someone tells you that trading is easy, that person doesn't like you, because that trading is not easy at all, right? So you have to structure how you trade as a business. You have to treat it as a what? As a business, right? So you need to choose a methodology or a strategy that resonates with you. So you need to choose something that that works for you. You need to choose a strategy that works for you, that you are comfortable with, that is in line with your emotions, right? Because there are different types of strategies there, and people choose different strategies, which is fine, right? So you need a methodology, and you need to backtest the strategy, right? So that you know the weaknesses and the strengths of the strategy, right? So that you have confidence in your strategy, so that when you start taking trades, you don't have that fear, you don't have that hesitance. Why? Because you have backtested the strategy. You know what your strategy can do, you know the limitations of your strategy, right? You know the weaknesses. And when those losses start occurring, you know that it's part of your strategy, right? Okay. After that, you need to create your own rules, right? Okay. And blend them with those of the strategy, right? So every strategy has its own rules, right? But then after big testing, you see that yes, the strategy have its own rules, right? Okay. But you also need to create your own unique what? Your own unique rules, right? It's very important to have your own rules, right? Another point, you have to keep a trading journal. You have to write down the trades that you take. You have to write the way you were feeling when you were in the position. You have to write a lot of things there. We will not go into detail. And the last part, you have to follow a simple, effective routine, right? Which means as a trader, you need a what? A routine. When you wake up, what's the first thing you do? Right? What's the second? What's the third? You need to structure your day. Every day you have to structure your day. So in other words, you have to be disciplined. You have to be disciplined. If you say, okay, this is how I structure my day. In the morning, right? I focused my what? In the morning, I focus my trades. In the afternoon, maybe during the day, you trade, right? In the evening, then you do your journaling. You start writing the trades that you took. uh, if there are winners, the lesson that you learned from those winners, the lesson that you learned from the losers, if they are losers, writing all those things, right? That's treating trading as what? As a business. And this benefits your what? Psychology. Okay, so now we want to move to the what? To the charts. I know people, they like the charts so much, right? So we want to show you, I want to show you psychology on the charts, right? So I have what I call psychological areas, right? Psychological areas. These are areas whereby traders are being traded in the markets, right? So I have support and resistance. I have previous highs and lows. I have the third touch and the fourth touch of a pattern. I have order blocks, right? So my trading method is based, or it's built on what? On patterns. I focus on patterns. I focus on structure. Let's go on to the charts and see what I'm talking about. Okay, so we will start with the support. We'll start with the support and the support and resistance. We want to see how psychology is coming in place on support and resistance, right? Okay. Let me go to the 4-hour so that we can clearly see what I'm talking about. Let me go to the 4-hour. Okay. So this is USDJPY, right? So we are on UJ, right? So we are having our support level there. One, that's our first touch. We are having our second touch there, right? Okay. So when we had our first touch, price went to the upside, right? When we had our second touch, the price went to the upside just a bit, and they came back, right? Breaking our support level. You can see it. You can see it. Sorry. You can see it. That H4 candle that is closing to the downside with momentum. They are breaking our what? They are breaking our. They were. Okay. We were taught that prices to retest, then push to the what? To the downside, right? That's what the textbook says, right? Okay, that was the textbook says. But look how price started moving back inside our structure, inside our what? Our support level, right? Why do they do that? Why do they do that? Because this is a psychological area. Everyone is watching, and what you should understand is in the markets there are only two ways to make money: buy low and sell high. So everyone is looking to buy low, and everyone is looking to sell high, right? So the crucial thing is, how do we spot the low points? How do we spot the high points, right? I may spot a low point and it may not be a low point to someone, right? So those things, they are crucial because those are the things that moves price in the markets, right? So you see that we had our support here. We had our first touch, second touch. On the third touch, price what? It broke the support and it started consolidating and it pushed back into the what? Into the pattern. So when these things happen, am I surprised with those things? No, I'm not surprised with those things. Why? Because I know that's a psychological area and it's supposed to happen like that. So what is important to me is to know and understand how are we approaching our area of value. You can see that pattern that we are having there. We are approaching our support level in a form of a what? Of a pattern. A pattern that I know that this is a continuation pattern to the downside, to the upside. I know that the trend is to keep pushing to the upside. Why? Because they gave me a continuation pattern. So when we approach our support level, it's either they are going to fake a breakout, then they shift momentum back into the pattern, then we continue to the upside. So that's a psychological area. They always do that most of the times, right? So it's very important. Let us move on to another pair. Let us move on to another pair, like USD card. Let's move to USD card. Let's move to USD card. Okay. So I'm on the daily. I'm on the daily time frame on USD card. We are having our resistance. We are having our resistance there on the USD card. We are having the first touch. We are having the second touch. And we are now having the third touch. Look how they break our resistance on the third touch. But breaking the resistance, does it really necessarily mean that we are pushing to the upside? Because the textbook says if we break, we expect a retest, then we push to the upside. But are we seeing that happening on the charts? No, we are not seeing that happening on the charts. What we are seeing is price is breaking back inside the resistance. And what is important, what I always tell the guys that the few guys that I teach is how price approaches an area of value, or how price approaches a psychological area. It's very important. You can see that, let me switch to a lower time frame so that you can see the pattern that is being formed, right? You can see that we are forming what we call an ascending channel. We approached the resistance with an ascending channel. So are we surprised seeing price breaking to the upside, then shift into the pattern? No, we are not, because we are approaching in a form of an ascending channel, and we know that an ascending channel, it is a reversal. It's a form of a reversal pattern. The price has to reverse. So this is how traders are being trapped on psychological areas, on support and resistance. So if you are a pattern trader, you understand, it will make sense to you. If you are a pattern trader, you can see that we are approaching in an ascending channel. We are not looking to buy here. We are looking to sell. Though price broke above the resistance, it doesn't, that doesn't matter, because we know we are having a what? An ascending channel. Okay, let's move on. I said that I use order blocks, right? So let's see an example of order blocks. Okay, so I will use Euro USD. I will use Euro USD as an example. Okay, let me go to the daily. Let me go to the daily and show you something. Okay, okay. Let me go to the weekly. I think my order block is on the weekly. Okay, so I will not go into much detail about the strategy or the things that I use, but I will try to help as much as possible. Okay, to the guys who trade order blocks. Me, I don't trade every order block. No. Right. So we can see here on this price action here, right, that I've circled there, we can see that we are pushing up, right? So we are having this order block here that I have circled, that is more of an hammer. This one, we are having that order block, right? Okay. So we know, or we have been told that when price makes an order block, it comes, retest it, and pushes to the what? To the upside, or retest it, pushes to the upside, depending on the type of order block. I will not go into detail on that one, but I want to show you how traders are being trapped on the order blocks, right? So we are having our order block. So I take my ray line, I marked the lowest point of the order block there. So on my ray line, I'm anticipating that prices to bounce and push to the what? To the upside, right? Okay, so now let me switch to the what? To the daily. Okay, so let me switch to the daily. Okay, so bear in mind, the way we approach an area of value, it's important. It's not about just prices there. No, it's how did we reach that point? Those are the questions that you should ask yourself. So this is how we reached our area of value. We formed this pattern, right? This is how we reached. We had our first touch, second touch, we had our what? Our third touch there, right? Okay, so we are expecting price to rise in that area, but we can see that on the daily, we had a break to the downside. That candle breaking to the downside, but touching our what? Our trend line, then push to the what? To the upside. Okay, that was psychology in play there when the guys broke that low, that sorry, when they broke our order block area there, then respecting our what? Our trend line, then they pushed up. But what is important is how did we approach? We approached in form of a what? Of a pattern that we know that this one is a continuation pattern to the what? To the upside. Price will continue to the what? To the upside. But in our mind, nothing is guaranteed. We are treating everything as probabilities. There is nothing code obvious in the markets, right? Well, let me take another example. Why am I saying that? Okay. Let me clear my chart a bit. Okay. Okay. I will take, this is called a ray line, guys. To those who don't know, this is a ray line. Okay. I take my ray line, I put on this low. Okay. Let me indicate the low that I'm talking about. Okay. This is the low that I'm talking about, right? I put my ray line on that low, right? Exactly. Then I'm expecting price to come and respect my what? My low, and then push to the what? To the upside. So I'm saying prices to come here and respect and push to the upside, right? Tell me, guys, didn't price came each time we pushed up for the first time, respecting, right? Respecting the law. We respected the law there. You can see that that one candle, that green candle there here, right? We respected the law there. Okay, let me remove so that you can see. Okay, we respected the law there, right? After respecting the law, why did they come back again